ROCE. Why it is one of the most crucial factor to consider when investing in any company. We will not look into the mathematical aspects of the formula, but see why and how a company can improve their ROC and how they can use the capital more efficiently. How companies are doing it, and we will even see companies that have ROC of more than 100%. So let's begin. ROC stands for Return on Capital Employed. And as the name suggests, it's the management or the team who is running the business. What is the return that they can generate from the cash or capital that their business is deployed with? So let's say if I put some amount of money in the business, I need to generate returns out of that invested amount. And if that return that I'm generating from the business is not more than what I would get in a bank, keeping it in a bank account or a fixed deposit, then there is no point in doing the business. So ROC below a certain level means that you are working for the bank. Instead, you can just put that money into a bank account FD and then don't do the business. So ROC is one of the most important factor to consider when investing in a business. Mathematically, the formula for ROC varies from site to site, and textbook formula is EBIT upon capital employed. So it's earnings before interest and tax upon the total capital employed. But the capital employed, the calculation for capital employed varies from website to website. So if you look at say on screener.in or on Value Research Online for a same company for the same financial year, the ROC will vary a little bit. So let me just look into Asian Paints ROC for say March 2020 on a consolidated basis. On Screener is 34%. On say Value Research Online, I see it as 35.78%. So it can vary a little bit, but we are not interested in a textbook formula, and we are not even interested in understanding the calculation behind each of those sites. So any one can be used as a benchmark, and then use that benchmark to invest in companies. So we will not get into the details of the textbook formula any further. Why ROC is important? So ROC helps you understand the financial efficiency of the management or the team that you want to invest in. So any business will require capital to grow. They want to be setting up new factories or want to be expanding into say buying lands or anything. So every business needs capital to grow. Now if a business is generating a return that is much better than say FDs or say any secured return aspect, if a business is generating better returns than that, then we should consider investing in that business. If not, then it's better to invest in fixed deposit. So any business that is able to generate a return of more than say 15% is a good business. I classify ROC into three categories: great, good, and ugly. So above 15% or even above 20% is a great ROC. Between say 10 to 15% is good or okay ROC, and under 10% is ugly. So once the ROC is under 10%, I don't consider that stock for investing unless there is something that I see which a company is trying to increase the ROC levels. Then I wait for the ROCs to improve, or I wait for certain parameters to come in line, and then maybe consider that for investing. Finally, we will look into how can companies improve the ROC, the earnings remaining the same, the operating profit margin remains the same, every other parameters remains the same. Is just the way they do the business can help them improve the ROC, and once the ROC improves, everything else falls into place. So let me help you understand this with a very simple example. Let's say a company is producing a product which is worth 1 lakh rupees on a daily basis. So now on the first day it may produced that product of 1 lakh rupees. Now this product has to be shipped to its dealer, and then dealer will move it forward to the retailer, and ultimately the customer will buy from the retailer. Quite normal process. So on day one, uh, the company produced this 1 lakh rupees, then say 10 to 15 days it takes from a company to reach to a dealer. Then a dealer has a terms and conditions that I will pay you once I get the products after 40 days. This is quite normal because he has to pass it on to the retailer, then retailer will show it on the shelf, and then once it's sold, the money chain flows back to the retailer, dealer, and then back to the company. So retailer has say 40 days time to get that done. So around in 50 days time, or around 50 days time, the company will get the money back with itself. So on day one, whatever the company produced, it will take 50 days, and then on the 51st day the company will get the payment for it. So let's say if the company wants to keep on producing for each day until the money comes back with profits, it has to have a 50 lakh rupees of capital. Now the same company doing the same product can transport the product that it produces in a smaller span of time. Say instead of 15 days it takes 5 days, or if the transportation or it can move its factory in a place where the transportation days are low, or what it can do is it can ask money from the distributor on the next day, or say in 10 days. If the product is very high flying, so let's say once the retailer gets it on the shelves and it goes off to the customer directly, or customer is more than willing to pay it on the day it arrives on the retailer's desk, then everyone will pay the company faster, and company can, let's say if it can reduce this cycle from say 50 days to 25 days, now the capital required to run the same business in a same efficient way is 25 days. Now let's see if the profit changes in both the cases. So in first case it was producing 1 lakh rupees, and let's say the final payment is that the company would be getting is 10,000 rupees more than the cost of the product. So then what happens is, so on day one it produces of 1 lakh rupees, but on 51st day it gets 10,000 rupees as profit. So now for the 90 days we assume that in this quarter every day they produced for 1 lakh rupees and sold it for 1 lakh 10,000 rupees. So then the profit for a 90-day period is 9 lakh rupees, because every month they will be making 3 lakh rupees, and 3 lakh, 3 lakh and 3 lakh, that would be 9 lakh rupees. So 9 lakh rupees is the profit generated with a capital required of 50 lakh rupees. Now let's say if the payment comes in 25 days, then what happens is with 25 lakh rupees the profit still remains the same. So cash flow increases, and we see that the profit remains the same. Now the company may just do certain tricks, like they may give a 1% extra discount for a faster payment, or they may have certain perks, like say some targets achieved and they take some extra bonuses or benefits, or they offer some trips or things like those to make them achieve those goals or get the money in shorter span of time. This is how companies deploy the cash, and they can do efficient business with the same amount of capital, or even less amount of capital, they are doing the same amount of profit. So once you are generating more profit on a less capital, the return on capital increases and your profits increases. Now there is a second aspect to it, which is the raw material that you need to produce that 1 lakh rupees worth of product, you have to pay them as well. Now if you can delay that process, so you can ask payment faster from your distributors and retailers, but if you can delay your suppliers, again you will have ample amount of cash to generate more of a you can hire or you can recruit more of your dealers and retailers without deploying more cash. Let me just explain two terms over here. First is debtor days. Debtor days is the number of days a company requires to get paid from its customers. The second is Days payable. Days payable is the number of days a company needs to pay its suppliers. So then what happens is, if we see these two ratios on screener for companies, you will be astonished to see that there are companies who are generating a ROC of triple digit, more than 100%, because they are paying their suppliers after say 5 months or 6 months, and they are asking payments from their customers or distributors in a matter of say weeks. So once the company is able to do that, then their ROC shoots up. If a company is not able to do that, then their ROC will be lower. Let's look at the few examples to help us understand this better. The company that I am talking about is Hindustan Unilever. So in Hindustan Unilever's ratios tab, we see that debtor days are in teens. So for 14, 16, 11. So it is asking its customers to pay in a 2 weeks time. So let's say the whatever the amount of goods it is producing, it goes to retailers or distributors and then retailers, or whatever is the supply chain that they whatever is the chain that they have. The final person is making them pay in a 14-day time period, and you see the days payable is around 170, 160, 145. So they are paying their suppliers after say 5 months, 6 months time. So then what happens is, they are getting the money for the products sold, but they are not paying their suppliers that upfront. So then what happens is, they are getting a lot of cash as a capital, and they possibly may not need capital to grow. The business itself can fund and grow itself. And you this thing happens like you can ask your customers or retailers and distributors to pay very fast once your product flies off the shelf very quickly. So yes, we know, Hindustan Unilever has those kind of products that we use on a daily basis. So then the retailers or the shop owners that are there, they are willing to pay almost instantly for the products that are there on the shelf, because they know that the product will be sold off in a day or 2 or 5 days, 10 days time. And so they can reduce the debtor days considerably, and they have a days payable much higher. Also inventory days, so the number of days for which they keep an inventory. So let's say a truck is being loaded and they don't want to load with multiple products, so then they may be keeping it as an inventory. Let's look at second example of Asian Paints. It is also one of those companies that has consistently ROC above 30%. So again, we see that it has a debtor days in range of 30-40 days, and days payable close to 100. Sometimes 80, sometimes 90, and sometimes even 119. So once they have so much of cash flowing in with the same amount of profit, they don't need capital to grow, because the business itself is able to generate a lot of capital that they need. And let's say they want to set up a factory, they have enough cash capital in the flow to be able to do that. Similarly, they have around 130, 140 days of inventory as well. So let's say there are inventories that they keep for any sudden demand or things like those. Let's look at third example, and I have taken a very unique FMCG product or FMCG company only, and it's called Dawat or LT Foods. Now LT Foods I have chosen specifically because it has an ROC of around 15%, and there's a reason behind it. Again, it also has a 30-40 days debtor payables, and days payables is around 60-70. So once they can increase it to 100, the ROC will increase definitely. But more than that, we see a very critical thing, which is inventory days. Inventory days are always above 250 or around 250. There is a reason behind it, because this is a rice producing company, basmati rice, and aged basmati rice has much more value. So once you want to age your basmati rice or age your products, you have to buy the raw material, store it in your say warehouses, age it, and then you can sell it. So you need capital to do that, and that's why this is a high capital business, and so the ROC has to go down. Once that business requires a lot of capital, you require to pay things upfront, then your return on capital will always be on the lower side. Hope this helps you understand the concept of ROC and how ROC is crucial for any business. Same profits, same earnings, same say EPS, and yet if a company has an ROC much higher, then it can quickly grow and expand its business without diluting its shares, or without taking money from the market, or without taking say loan from the banks or anything. So the growth that the company may want to be doing it can be done without any additional capital. Hope it helps.